So let's now look at the ETF option strategy, and we also trade options on the strongest ETFs. And the trade selection is the same for purchasing an ETF. The option strategy trade selection is the same. We select a sector with a high relative strength. We like to see 90% or better. And then before we buy a call option, we want to use the Keltner channels to find a low-risk entry for our call option purchase. And then we use what we call the 1% rule to select the option strike price. And options are derivatives, and they derive their value from the price movement of the underlying stock. So we use ETF relative strength to identify ETFs that are moving up in price. And if you can identify an ETF moving up in price and you buy a call option, that allows you to profit from the tremendous leverage that call options provide. So let's look at some sector option trades that we have. The first one's for the utilities ETF, and again, we saw in the previous example when we purchased the ETF itself, 94.5% relative strength. So we also bought the XLU 42 strike call at 630 right in here as the stock retraced, the XLU ETF retraced towards the middle Keltner channel. We jumped in and bought the 42 strike call. And again, it got us a low risk entry. And we can see we bought the April 40 strike call at 630 right in here. And we have since rolled this option over to a September option, and we're still profiting from this trade that we took back at the beginning of March. So again, Keltner channels allowed us to get a low risk entry for our ETF option trade. And the XLU has recently retraced towards that lower Keltner channel, so that's one worth looking at if you want to purchase the sector right here, the ETF symbol XLU, or buy a call option. You can see it got overbought there in July and now has retraced towards that lower Keltner channel. So that's worth looking at to purchase either the ETF or an option. Here's the Vanguard Real Estate Investment Trust ETF again, and has a high relative strength, 93.5, and we waited for it to retrace here. It was in a pretty strong uptrend, so we waited for it to retrace, and then we bought the September 70 strike call at 1334. So we bought right in here, and with it trading up around 90, we have a nice profit in this September 70 call that we bought in mid-April right in here. And VNQ is also on a buy signal right now because it got overbought. Now it's retraced towards that middle Keltner channel, so that's another one worth taking a look at for a long position. And the last example is that dividend ETF DVY, 90% relative strength, and we went ahead and bought the September 70 strike call at 1170 right in here when it retraced towards the middle Keltner channel, and again that gave us a low risk entry, and now we have a nice profit on this option. And also DVY is also has retraced towards that middle Keltner channel, so that's another one worth taking a look at for a long position. So again, with the option trades, just like the ETF trades, the option trades, the Keltner channels resulted in low risk entries, and as the underlying stocks didn't retrace much from our entry point, and that helps prevent getting stopped out of the position. Here's our ETF option portfolio. This has a average open trade profit of about 42%. So this lists our ETF option trades and average return of about 42%. And one other thing I wanted to mention when you're purchasing an option is we use what we call the 1% rule for selecting that option strike price. So once you select an option trade, there's hundreds or even thousands of strike prices to choose from. So selecting this strike price is very important because you have so many different strike prices to choose from. So that becomes a very important part of the trade selection. So option premiums consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you're buying a decaying asset, and each day the time value of that option is decaying, and when you get to expiration, options have no time value. Their time value goes to zero. So you always want to keep that in mind whenever you're trading options, that you're buying a decaying asset, and it decays a little bit each day until expiration. So due to these time decay characteristics of options, when buying an option, you want to minimize time value because that's going to decay to zero, and you want to maximize the intrinsic value of the option. And the way we do that is we limit the time value portion of the premium to less than 1% of the stock price. And if you do that, then you'll minimize the time value, maximize the intrinsic value. So if you purchase an option and the stock is trading at 100, then you want to limit the time value to 1 point or less, which is 1 point would be 1% of the 100-point stock price. So if you limit that time value portion to 1% or less of the stock price, then you're going to maximize the intrinsic value, minimize the time value. Here's an example. This is the dividend ETF 70 strike call, September 70 strike call that we purchased for $11.70. So when we purchased the 70 strike call, the ETF, underlying ETF, DVY, was trading at 81.38. So this is an in-the-money call, as the 70 strike price was less than the current stock price of 81.38. So these, if you use the 1% rule, then you're going to be buying in-the-money calls. And let's look at the breakdown on that option premium. DVY ETF was trading at 81.38. The call strike price was 70, so we bought the 70 strike call. If you subtract that strike price from the stock price, you get an intrinsic value for the option. In this case, the intrinsic value was 11.38. So the total option premium was 11.70. We paid 11.70 for the option. So the total premium was 11.70. If you subtract the intrinsic value of 11.38 from the total premium, then you get the time value. In this example, the time value was only 32 cents. So what that means is the DVY ETF, it only has to go up 32 cents for this option trade to break even and for us to start profiting. So that's a very small price increase in the ETF, and then we start profiting with the option. So ETF only has to, in this case, go up 32 cents, and we start profiting on the option. And we developed a series of 6 different calculators that will calculate the profit potential for our option strategies before we make the trade. So this is the call option purchase calculator, and what this does is calculate the profit potential for this trade that we made when DVY was, the stock price was trading at 81.38. We bought the 70 strike call at 11.70. So what the calculator did was calculate the profit potential for this trade, assuming various price changes in DVY at option expiration, from, in this case, a 30% increase in the price to a 5% decline in the price. So it'll calculate the profit potential, and the bottom row right here gives you the percent return for the corresponding change in the ETF price at option expiration. So we can see if the ETF was up 20% at option expiration, then the option would have 136% return. If the ETF is up 10%, then the option will have a 66% return. If the option is flat at 81.38 at option expiration, then the option will have a 2.7% loss. So we'd much rather buy these in the money calls, and you can see if the if the stock's flat at expiration, we only lose 2.7%. Now, if we bought an at the money or out of the money call and the stock is flat at option expiration, then you lose 100% of the premium. So we don't want to ever be in that position. So we buy these in the money calls, and you're less leveraged, but at the same time you can still make a good return. And in this example, if the ETF's up 10%, even though it's an in-the-money call and you paid more for the call, you're still going to get a 66% return. So that's a pretty good return. And for an in-the-money call for a 10% increase, and again, if it's up 20%, we make 136%. So the option purchase calculator also will calculate the time value and the intrinsic value. And in this example, the time value was 32 cents, intrinsic value was 11.38. So you can see with the premium trading at 11.70, this is mostly intrinsic value, and that's why we use the 1% rule. So to summarize, with 32 cents of time value, DVY only has to increase 32 cents or 0.4% for this trade to break even, and any increase in the stock price above 32 cents will result in a profit. So it doesn't take long with these in-the-money calls. If your timing is good and DVY goes up 32 cents, then you start making money. So we'd much rather trade these in-the-money calls than out-of-the-money calls. Out-of-the-money calls typically can require a 10 to 15% move in the underlying stock just to break even on the trade. And many times the stock or ETF, it will not make that expected price move at option expiration. And if you have an at-the-money or out-of-the-money call and the stock is flat or down at all, then you'll lose 100% of your premium. So the goal is we don't want to take these big losses. So we use this 1% rule to select the option strike price.